Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Zach Unger, an analyst for our allocation team. So happy to have Zach on here. Last time he joined us for the Market Carver, I would guess, Zach, that at that time you were a level one candidate for the CFA, and in between then and now, you've moved from being a level one candidate to passing the level one, and in turn becoming a level two candidate. So I just want to make that known to everybody who's watching and may not know that the CFA program that we're talking about is a very rigorous, very difficult set of exams. There are a total of three. Usually takes about 3 years to move through, and so passing the first of the three on the first try is a huge move. And so that's Zach, and already bringing a lot of that knowledge and the things that he's learning to the table. So things we're going to talk about this week. We don't have a long list. Because we think there's some richness and some depth to these two topics and some important things to discuss. We're going to talk about sectors and the way they've come out of the gate and how we've set up for 2023. And then also we're going to talk some in-depth stuff on the real estate market, specifically with regard to conversions, and not Roth conversions. We're talking real estate conversions. And we'll get that to just a second. But first, Zach, I'll let you lead off and kind of walk us through what we're seeing so far in terms of sector leadership and what that might mean to the portfolios that we manage.
Yeah, so we've got a chart here of the sector performance through the first month of 2023. And what you'll see, or what you'll notice, is that the leading sectors so far in 2023 are actually almost in exact order the sectors that underperformed the most through 2022. And so for the basketball fans out there, this situation that we find ourselves in is similar to when you have your team that has jumped out to a sizable lead, and then the opposition goes on a fairly solid run to draw the game close again. And as a coach, you have the decision to either A, call a timeout and make some adjustments. That would be akin to us making some pivots allocation-wise inside of our portfolios, or B, you can let the game go on and sort of fight through the difficulty. We do not have a high allocation to these outperforming sectors in 2023 because they underperformed so much. And so that's sort of where we find ourselves. But for us, we lean towards the latter as for now. And that's for two main reasons. The first reason is that this rotation from underperformers to outperformers is fairly common. Typically, you'll see the underperformers from 1 year rebound a bit into the following year and make up some ground. And so it's not uncommon to see that. But then the second reason, if you look at the top sectors there, communication, consumer discretionary, tech, all of these sectors are ones that could face potential headwinds later on in 2023. Consumer discretionary, for example, you have the potential of a more difficult economic environment that could make for a more challenged consumer. And then tech, as we've talked about in the past, we've seen the value over growth revolution sort of materialize a little bit more in the past several months, and a lot of those names in the tech sector are more growth oriented. And so we find ourselves sitting in a position where we're just going to kind of let the game run on and fight through. We believe in the allocation that we have to the current sectors, but it is a good update to see where the sectors are so far in 2023.
Yeah, absolutely, Zach. I've heard nothing really to add there. You hit the nail on the head, and the things that we're facing, the back and forth nature of the market. And yeah, I'll just have nothing to say but to emphasize you're exactly right. And one of the reasons those changes happen, that you go from the laggards going into the leaders, is known as the impact of short sellers on the market. People who have heavily bet against those, once they begin to take some profit. So people who bet against Tesla and Facebook, Netflix, companies that really fell hard, companies that bet against them did really well last year. And so as they begin to take profits, that could rebound extra fast as they kind of pile on and do what's known as short covering and chase each other. And we've seen that in a high representation. Those sorts of moves usually don't have a ton of legs. So therefore, we're not super eager about chasing those just for January. Put it simpler, we're just looking for water to find its own level. So moving now to the real estate market. So for most of the investments, whether it's stocks and bonds, cash, we manage that very in a core portfolio, what we call our all equity, growth, balance, conservative, our model portfolios that represent the vast majority of assets we manage. Real estate is a very personal investment, and it's different for each and every one of you. Some of you have farm grown, some of you have investment property. So weaving that into what may or may not be available on the real estate market is very individualized. But here is a snapshot of some of the dynamics we were facing as we put to the end of 2022. On the left panel here is really the most technical or really detail oriented factor. We're looking at what's known as the cap rate. A cap rate is simply a valuation tool. For those of you that have managed your own real estate or made transactions, you'll be familiar with that. Think of it as the inverse of a PE ratio. The higher the cap rate, the cheaper the real estate is. The lower the cap rate is, the more expensive it is. What the chart on the left is putting that cap rate in terms of how far above U.S. Treasuries it is. So if you have the U.S. Treasury at 3% and a cap rate at 3%, that would be if you had a spread of 3%, that would put your cap rate at 6%. And you can see that is what the average is over time, U.S. Treasuries plus 3%. And so we wound up just a little bit on the expensive side of that, actually. We've not seen a whole lot of softness in real estate in broad terms. So if we were to revert to historical means, there could be some give in some corners of the market. The right panel breaks down the fundamental or the vacancy rate across the different major food groups of commercial real estate. You've got apartments, or what many call multifamily units. Gray is office, the green is industrial, and then blue is retail. They all perform differently at different times. Usually it's important to have some diversification, just like with any other investment. But what's done really well is that industrial sector. When you think industrial, the biggest driver of that is warehousing. So things like Amazon and e-commerce have really driven a lot of demand for that industrial real estate. And so vacancy rate, the amount of space that's available is so far below average. I mean, it's down there less than 2%. So a really, really tight market for industrial space. So that means that has been a good performing area of the market. The thing that the tone of caution that we would have for warehousing is traditionally that is some of the easiest to build. You could put up 4 walls and put a lot of space in between. I know that's really oversimplifying it, but you could put up square footage and a lot of it really fastly. So you don't want to be overexposed just as that market corrects. On the flip side of that, it should come as no surprise, the real laggard, the real concern is on office. And so if we put that chart back up and look at the vacancy rate for office, we are pushing what could be historically the highest level of vacancy that we've seen in office ever. That remains to be seen if we will hit that, but it is quite possible. So you have two things there. You have the lingering effects from work from home. So there has been some return to the office, but some people have found either a hybrid or some sort of permanent work from home situation. And you have what is an attempt by the Federal Reserve to put the brakes on unemployment. So there could be, if we do have the Federal Reserve successful in raising the unemployment rate, that also would be not good for office space. So those two reasons have that challenge. But also, I think just like industrial real estate can adjust in markets, having a lot of profit or a lot of valuation in those can induce supply for people to build them. The opposite can happen on office. And that is what we're seeing across the country is the supply of office could come back down. As with real estate, it is so true. Location is what matters, and all geographies are different. But across the country, and especially those large cities, we are seeing a lot of that office space being converted to different uses, namely multifamily. Traditionally, and typically, that is not a desired thing by the real estate owners, because if you think about it, when you rent an office, you're renting the whole space. If you convert it to multifamily, you've got common areas and halls, and space just kind of falls off there. But because the price level and the demand and the supply dynamics are so far off, we're actually seeing a lot of that take place. You're seeing things like Times Square, part of that building being converted by Caesars from office into actually casino, and parts of the Empire State Building also converting its office to multifamily. So everywhere's a little bit different, but we are seeing a massive move in that place. It'll take time, but I think it's a beautiful part of capital markets, Zach. Markets function over time, and when supply and demand interact and adjust along with prices, markets respond with changes to supply and demand, and that's what finds us working towards equilibrium over time. And that's what we have to pay attention to when we do have those real estate conversations. That'll be a wrap for now. We are very thankful of you giving us a few minutes of your time to talk about these two topics. As always, we'll leave you with a reminder to reach out and give us a call. As always, if you schedule a meeting with us, we promise that you will leave. Whether or not you decide to work with us, you will leave with an idea or a series of steps that you can think about to take along your financial journey. Or if we have the pleasure of working with you, of course, we look forward to seeing you in your family update, whether that's near or towards the middle of the year. Either way, don't be hesitant to give us a call and reach out and set up an appointment. 800-928-4001. Thank you and have a great weekend.